I'm Michael Sabo, Senior Market Strategist with RJOF Futures here in Chicago. Bringing you another webinar here in our series here of trading options. And today I want to talk to you here about an option strategy. So let's get started. Futures and options on futures involve substantial risk and may not be suitable for all investors. So what is an option? Let's just touch on this briefly. An option is a contractual agreement that provides the buyer the right, but not the obligation, to buy or sell an underlying asset at a certain date at a set price. And when you purchase an option contract, there's always someone on the other side of that option that is selling it to you. So for every buyer, there's a seller. And when you purchase that option, you are paying the seller an option premium. And so that's the price that you pay for that right. Premiums fluctuate on a daily basis on the exchange, and there's price movement is going to occur based on what the underlying futures contract is doing. Is generally determined by the Black-Scholes model, and that's how options determine their value. And in futures, the underlying asset is a futures contract, generally that has the same expiration month as the option. So today what we're going to do is we're going to talk about a scenario here if you happen to have a bullish outlook on a particular market and you're looking for a way to take advantage of the prices moving up. But you want to do it in a way that limits your risk. So unlike a futures contract that has unlimited risk, we're going to look at the long bull call spread. And so basically a long bull spread consists of two options, both in this case calls. So the idea is that you would buy the lower call strike price, so you're going to pay out premium for that one. And at the same time, or simultaneously, you're going to sell the higher call strike price. So you're going to sell that to someone else, and the premium buyer and the one you sell, they're going to pay you the money for it. So you're going to collect the premium. And that's going to be done in the same contract month in the same ratio. So, for example, and we're going to go over an example, a real life example, you'd sell 1-to-1, or you could sell 2-to-2, or 3-to-3. If you were doing a ratio spread, such as buying, let's say, 3 and selling 2, or you're buying 2 and selling 3, that would be referred to as generally a ratio spread. But here, this is a long bull call spread. It's a very popular, very common trading strategy in the markets. So let's go over an example here, a real-life example, and that's really the purpose of this particular webinar, is just to kind of touch base on it and go into a little bit of detail of how a bull call spread works. And here in this example, we're going to use the oil market. So August crude oil, this is last trade at $61.30 a barrel. And let's say you believe that you're going to see prices move higher over about the next 30 days. You think that crude prices could touch up to at least $66 a barrel or so. So you're looking for a modest move in the market here over the next 30 days. And this is all based off of the trade date here. The price is here on June 11th. So, there was a couple different ways to play it, but let's say in this particular example here, you want to go about doing a bull call spread because obviously there's a possibility crude prices could fall, and so you don't feel comfortable maybe going with a futures contract, and you want to give yourself some staying power in the market. So let's talk about the oil here for a minute here, the contract specifications of oil here. So, and oil options. So August oil options expire on July 16th. So as you can see here, you have a little over a month. Crude oil, each crude oil contract is based off of 1,000 barrels of oil, and a 1 cent move equals $10. Because of course, if you had 1,000 barrels of oil and the price went up 1 penny, you'd have 1,000 pennies, or move the decimal point, you'd have $10. And let's take a look here at an oil chart here. This is a daily chart here on crude oil, on the August crude oil chart. And this is actually, this chart here is taken off of our trading platform, the RJOF Futures Pro. which is a great platform to utilize. And what we see here is the daily price action, which of course are the vertical bars, represents 1 day. And we have the green line there is the 10-day moving average, the red is the 50-day moving average, and the purple is the 200-day moving average. So you can get an idea approximately where crude prices are trading at. And you can see, again, in this example, we believe crude prices are going to break out and start to move higher. So, again, based off of June 11th prices here, we're going to look at this bull call spread here. So, in the example here, you'd be buying one August crude oil $62 call at $185. And so what that represents is $1.85 in premium that one would pay for the $62 call. So if you just bought the $62 call outright, you'd pay $1.85 or $1,850, because remember the multiplier is $10 for each penny. So again, this is something you could do here to lower your overall cost basis. And again, because we don't think that crude prices are going to go much higher than $66 a barrel in this example, we could take advantage of that by selling the $65 call. So if you simultaneously sell one August crude oil $65 call at 80 cents, as the seller of that option, you bring in the premium, or the seller would pay you $800. So as you can see there, $1.05 or 105 cents is the difference in premium. And because you're buying the lower strike and selling the higher strike, you're going to pay out that $1.05. Or if we take $1.05, which is your premium paid, times $10 a penny, that's where you come up with $1,050 is in what you would pay out in premium. And now you own a bull call spread. Now, this is a calculated risk trade. Even though you are selling the August crude oil $65 call, you have purchased and you own the right to buy crude oil at $62 a barrel. So you want to think of it that you may be obligated to deliver it at $65, but the only way that you would have that obligation is if that option was in the money at option expiration. And you own the right already to buy it at $62. So the idea is that you can buy it at $62 and deliver it at $65 if the position was fully in the money at option expiration. So that's how this trade is a calculated risk trade. In this example here, if crude is $65 or higher, you have no risk on it. And as I mentioned earlier here, these options expire here on July 16th. So let's look at the potential profit on this trade, and we'll also talk about what you stand to lose if the trade doesn't work. So potential profit here is it's simply to determine that and calculate it. It's the difference between the two strike prices minus the premium that's paid. So if you have $62 and you subtract that from $65 here, that gives you $3. So $3 is the maximum that you could make on this spread. And if you multiplied that out, $3 again times 10 cents a penny here, that would be a $3,000 max gross profit. And if you subtract the premium that you've paid, which is $1,050, that would give you a potential net profit of $1,950, and that's before your transaction costs. So it's important to remember that this is two transactions. You're buying the one $62 call and you're selling the one $65 call. You can put this order in on a spread ticket so that you're just specifying the premium between the two so that the two orders are executed simultaneously. But it is still a standard in the industry. These are two separate contracts, and so you do incur transaction costs on each one. So you'd want to also calculate in your commissions and fees on that here, but your net profit before your fees would be $1,950 if at the time of option expiration the market was at least $65 or higher. Could be at $65.10 a barrel, or it could be up all the way up at $70 a barrel. There is a calculated profit potential on this. Now if we look at the risk scenario on this, your risk is limited to what you paid that $1,050, the premium that you actually had to pay out. So again, that's the difference between your buy and your sell, and of course you'd have to add in your transaction costs to that. So if crude prices were below $62 a barrel at the time of option expiration, doesn't matter if the market was at $61.50 or if the market was down at $55 a barrel, your maximum risk is limited to the amount of premium that you paid plus your transaction costs. Now, it's important to also understand, for those of you, of course, that are new to this type of trading and are new to option spreads, that if the market, let's say, is somewhere in between there, let's say the market, it does move a little bit higher, but let's say the market only gets up to around, let's say, $64 a barrel. Well, what happens? Well, your $62 call is in the money by $2. And your $65 call is out of the money. So at the day of option expiration, if crude's at $64 a barrel, the $65 call would expire worthless. So you would keep that premium, and your $62 call, we would need to go ahead and offset that. We can either offset that through go ahead and just sell the option outright, or you could sell a futures contract against it at $64 and let the $62 call exercise and look to have it offset. But if the market's at $64 and you have $2 of intrinsic value in there, that means that the trade would be worth $2,000. And so $2,000 minus out your $1,050, you would have a $950 net profit before your transaction costs. So it is still possible to make money on the position, even if it's not fully in the money. And again, here in this example, let's even assume that the market is even that high. Let's assume that the market is only at $62.40 a barrel. So you're only in the money 40 cents. Well, if your cost basis is $1,050, that's your premium that you paid out, and you're able to sell this trade for 40 cents, you still bring in $400. So overall, you would have a loss on the position, but you would still be able to bring in at least $400 to offset that $1,050 in the premium that you paid. So the idea is, clearly the idea here is what you want to do is you want to see that market make a move above $65, the day of option expiration or slightly before. And to clarify, it is possible to get out of this trade at any time. So let's say, for example, there's a lot of things that are affecting the oil market right now. We've seen strong demand right now for the RBOB, which is the unleaded gasoline. We've seen falling stockpiles, the EIA reports, we've seen drawdowns. So let's assume here that there's some things heat up here and crude prices really take off to the upside. And let's say within the next 2 weeks, crude prices are trading over $65 a barrel. What would this spread be worth? Well, in our RJO Futures Pro trading platform, you can actually run what-if scenarios. So that's another helpful benefit of that platform. So you can actually plug in the numbers and it'll tell you based on time decay and where the market is at what the value of the spread would be worth. But the point is that the spread wouldn't be worth the full $3 until the time of option expiration, because options will have also time value in there. As well as, or possibly, intrinsic value, assuming the market's above $65. But the premium here, the spread, would increase in value. So it is possible to offset this trade before option expiration with a profit if the spread has widened. So in other words, if the spread has gone from $1.05 and the spread has widened out to, let's say, $2, it is possible you could offset this spread without holding it to the day of option expiration. So that's another thing to keep in mind. But generally, it's something where you'd want to look to anticipate holding this to near the time of option expiration, especially if the market is above $65 in order to realize the full $3 in profit potential. Just a couple of quick tips here for someone that's contemplating trading bull call spread. Some things to remember here is that this is a calculated risk scenario. And that's pretty important here for a lot of traders because that really connects here with the last tip here on this page here is the staying power. And that's one of the things that it does do. It does give you staying power in the market. So, let's assume you put the trade on and then crude prices pull back a couple of dollars and then turn around and rally back up. And it's something that it could possibly happen. Well, with this scenario here, with a bull call spread, you're paying for that spread in full, so you don't have a margin requirement to worry about. You don't put in like you would a futures contract where you put in a stop on this contract where you could possibly get stopped out and then have the market turn. So those are important things to consider. Now, it does have calculated profit potential, so you do have a little bit of a trade-off there. It's not unlimited profit potential, but a strategy like this can be very helpful in a market where you anticipate a move higher, but you just don't anticipate the market maybe making such an extreme move to the upside. And so that's one of the things that you should keep in mind. And in addition to that, also having a lower cost of entry. And what's important about that is that in the example that we gave, when you look at what the cost of the $62 call is as an outright, in the example that we did here at $1.85, so you lower your cost and you also lower your break even in the market. If you paid $1.85 for it here, that's $1,850 here plus your trade costs. You have a substantial amount of money invested into that. By doing the bull call spread, you reduce your costs here by quite a bit by selling that other option for $800. So that's something that's important that a lot of traders like to consider. And one of the things I'd like to mention here for those of you here that are newer to options here, we've got a great introduction to options guide, and you can certainly request that here from any of the brokers at RJOF Futures. That's a great guide. For those of you that are a little bit more advanced or are looking for a little bit more advanced information on option, we have some additional guides available. Our option strategy guide, and also 25 proven strategies for trading options. And this particular strategy here, the long bull call spread, will be mentioned in both. They're both excellent guides. And so we'll touch base here on another option strategy here in the near future. We put together another webinar. If you'd like to also check out, as I talked about, the RJOF Futures Pro, if you'd like a demo to that particular platform, where there's some great things in there on options that you can utilize, be sure to go ahead and contact us. We're more than happy to set you up with a demo to that. And also, I mentioned stuff here about the oil market. I write the column in our bi-monthly newsletter, the eView. So if you're not already getting that, that's a great place to turn to for not just information about the oil market, but other markets as well. And that can be a great newsletter to get sent out to you here twice a month. So I want to thank you all for attending this webinar on options.